The average American in their 50s has 188,643 Th sitting in their 401 neng at typical retirement spending rates. That runs out in 5 years. Not 20, not 10, 5, any. That number should terrify you. And if it doesn't, here's one that might. Vanguard published data in 2025 showing the median baby boomer is on track for a $9,000 per year shortfall in retirement every single year. That's not a rounding error. That's groceries, utilities, and medication gone missing from your budget permanently. But here's what nobody in the financial media wants to say out loud. The solution is not complicated. It never was. If you're over 50, 2 Vanguard funds, just 2, can do more for your retirement than the sprawling, expensive, actively managed portfolio your advisor has been selling you for the past decade. We're going to break down exactly which 2 funds, exactly how to split them, what the IRS just unlocked for you in 2026, and the one behavioral mistake that costs the average investor 848 basis points every single year. That last one stings. Stay with me. Your 50s are not a dress rehearsal. The most financially consequential decade of your life is happening right now. The math is unforgiving, but it is also, if you move now, extremely forgiving. 15 years at 7% turns $300,000 into $827,000. 15 years at 11% turns that same $300,000 to $1. $37 million. That $540,000 spread doesn't come from picking better stocks. It comes from choosing the right funds, minimizing fees, and refusing to panic. Let's get into it. Most investors in their 50s don't have a simplicity problem. They think they have a sophistication problem. They believe that managing retirement means owning 14 funds, rotating sectors, chasing last year's winners, and paying someone to make it all feel organized. The financial industry runs on that belief. It is extraordinarily profitable for them. Here's what the data actually says. Dalber's 2024 quantitative analysis of investor behavior tracked real investor returns against index returns over the past 20 years. The average equity investor earned 9.24% annually. The S&P 500 returned 10.35%. That gap doesn't sound catastrophic until you run the math on a 500,000 portfolio. Over 20 years, that 11% annual shortfall compounds into hundreds of thousands of dollars that never materialize. And that's the 20-year number. In a single year, 2023, the gap was 848 basis points. Average investors earned 6.54%, while the index returned 25.02%. They've underperformed for 15 consecutive years, not because the market is rigged, because complexity breeds bad behavior. Too many funds means too many decisions. Too many decisions under stress means buying high and selling low. Every single time. The antidote is not a financial advisor charging you 1%. The antidote is owning the whole market in 2 funds you never have to think about again. The first fund is VTI, the Vanguard Total Stock Market ETF, not a bet on 500 companies. Ownership of 3,503 U.S. list stocks in one ticker. Mid-cap, small-cap, every publicly traded company of meaningful size in the United States. The expense ratio is 0.3%. That is 3 cents on every $100 you invest. Per year, it tracks the CRSP U.S. Total Market Index, which is about as close to owning the entire American economy as you can get without printing money yourself. When people argue about whether to own growth stocks or value stocks, whether to tilt toward tech or lean into energy, whether small caps are about to outperform large caps, VTI makes all of that irrelevant. You own all of it. You don't have to be right about any single sector. You just have to be right that the American economy continues to grow over the next 15 to 20 years. That's the only bet on the table. The second fund is BND, the Vanguard Total Bond Market ETF. Expense ratio 0.035%. It holds the full spectrum of U.S. investment-grade bonds, treasuries, corporate bonds, mortgage-backed securities. As of right now, BND yields 4.05%. That's income. Real, consistent quarterly income that hits your account whether the stock market is up, down, or sideways. When equities drop 30% in a recession, BND doesn't follow. It stabilizes. It produces income. It gives you something to rebalance from, which means buying more VTI at lower prices without selling anything at a loss. That's not a minor mechanical advantage. That's the entire game. Together, VTI plus BND give you the whole US stock market and the whole US investment grade bond market at a blended expense ratio that sits around 0.03%. That's roughly 84% cheaper than the average mutual fund sold to retail investors. And the cost difference is not theoretical. Run the math. $100,000 invested for 30 years at 10% gross returns. In a fund charging 0.03%, you end up with 1,618,281 SUF. In a fund charging 1%, you end up with 1,004,073. The difference is 330,508 SUF. That money didn't go to you, it went to the fund company every year, silently, while you thought you were getting a good deal. Vanguard has been moving in the opposite direction. Since February 2025, they've returned more than $500 million to investors through expense ratio cuts. That's not a marketing line. That's a structural advantage baked into their ownership model. Vanguard is owned by its funds, which are owned by its investors. There are no outside shareholders demanding profit margins. The incentive structure is genuinely different. Now let's talk about the split. Owning VTI and BND without knowing how to weight them is like having the right ingredients and no recipe. Two rules of thumb have held up well for decades. The first is 1 or 10 minus your age. At 55, that means 55% in VTI, 45% in BND. The second is 120 minus your age, which accounts for modern life expectancies pushing into the mid-80s and beyond. At 55, that gives you 65% in VTI, 35% in BND. The difference between those two frameworks is your risk tolerance. If a 30% market drop would cause you to lose sleep and make emotional decisions, use 110. If you've got a pension, social security income, or rental income providing a floor, you can go with 120 and let more of your portfolio keep growing. Here's the part most people miss. The split is not permanent. It's a glide path. Every 3 to 5 years you shift slightly more weight from VTI toward BND. Not because stocks become bad, but because your time horizon is shrinking and volatility becomes more dangerous the closer you are to drawing down. At 65, you might be 50-50. At 70, maybe 40-60. The funds themselves don't change. Just the ratio. VTI and BND can mirror any allocation you want with a single adjustment. One number, that's it. There is an alternative pairing worth knowing, especially for investors who want the rebalancing handled automatically inside the fund itself. Wellington and Wellesley. Two of the oldest, most respected funds Vanguard manages. VinX, the Vanguard Wellington Fund Admiral Shares, carries a 0.17% expense ratio and runs a 65-35 stock-to-bond allocation. It has a 75-plus year track record. It is actively managed, which usually makes me put the remote down. But Wellington has earned its reputation over generations. VBIX, the Vanguard Wellesley Income Fund Admiral Shares, flips the ratio. 40% stocks, 60% bonds. Expense ratio 16%. It leans income heavy, which makes it particularly suited for someone at or near retirement who needs the portfolio to generate cash. Investing legend Paul Merriman calls these the two best Vanguard funds for retirees. Blend them 50-50, and you land at a 50-50 overall stock-bond portfolio, with automatic in-fund rebalancing you never have to touch. For the investor who wants simplicity at the structural level and doesn't want to manually adjust allocations, this pairing deserves serious consideration. The VTI plus BND pairing is cheaper and more flexible. The Wellington plus Wellesley pairing is self-managing and battle-tested. Both are excellent. The one you'll actually stick with is the right one. Here's what nobody is talking about loudly enough right now in 2026. The IRS just handed you something real. Standard 401(n) contribution limit this year, $24C $500. If you're 50 or older, the catch-up contribution adds another $8,000. That brings your total annual 401 contribution to $32,500. On top of that, your IRA limit is $7,500, including the fun $100 catch-up for your age group. But the biggest number is this one. If you are between the ages of 60 and 63, sure too. Zero created what's called the super catch-up. Instead of $8,000, your catch-up contribution jumps to $11,250. That means your total 401 contribution ceiling hits $35,750 per year. In a single 3-year window, ages 60, 61, 62, you have the legal ability to push over $107,000 into tax-advantaged retirement account. That window doesn't last. Use it. One update for high earners. Starting January 1, 2026, if you earned more than $150,000 in the prior year, your catch-up contributions must go into a Roth account, not pre-tax. That is not a penalty. Roth money grows tax-free and comes out tax-free in retirement. For most people in that income range, it's actually a better deal long-term. But it is a change you need to know about so it doesn't catch you off guard at tax time. Let's return to the behavioral gap for a moment, because I want you to feel this number properly. 848 basis points. In 1 year. That's not investors picking bad funds. That's investors owning decent funds and then making terrible decisions with them. Selling after a bad quarter. Waiting to reinvest after a crash because it might go lower. Moving into cash in 2022 and missing the 2023 rally. Moving back in after the rally and buying the top. The market doesn't punish bad stock picks nearly as severely as it punishes bad timing. And the cruelest part is that the investor doing this doesn't feel like they're making emotional decisions. They feel like they're being smart. They feel like they're managing risk. The data says they're bleeding. Two funds with a set allocation and a rebalancing calendar cuts the decision-making surface area where that bleeding happens. You can't panic sell VTI and move into gold if your entire strategy is VTI and BND in a 65-35 split that you rebalance once a year. There's nothing to do, and that's the point. The best investors are often the ones who do the least. Vanguard ran a study years ago looking at their best performing account holders over a long period. The top performers? Accounts that were forgotten. Account holders who had died and whose families hadn't touched the portfolios. That study gets cited so often it's become a cliché, but it keeps getting cited because it keeps being true. Your 50s are when everything compounds hardest. Not the decade to get creative, the decade to get disciplined. The mean retirement savings for Americans in their 50s is just over $1 million, but that number is distorted by the very wealthy. The median is $438,866, and the median 401(k) only balance is $188,600. That's the number closest to the average person watching right now. At normal retirement spending rates without Social Security, that runs out in 5 to 6 years. Social Security helps. But Vanguard's own 2025 data shows the median baby boomer still faces a $9,000 annual shortfall even after accounting for it. That's not a worst-case projection. That's the median. Half of baby boomers are expected to fall short of that. The window to fix it is right now. Not next year, not when the market looks better. Now. 15 years of consistent, low-cost, fully invested returns in VTI and BND can close a gap that feels insurmountable on paper. You do not need a sophisticated portfolio. You need a simple one you won't abandon when things get uncomfortable. VTI. BND. Set the ratio, automate the contributions, max the catch-up, rebalance once a year. That's the whole strategy. The investors who retire comfortably aren't the ones who found a smarter fund. They're the ones who stopped looking. So here's the question I want you to sit with. If you knew that 2 index funds, costing you less than 4 cents per $100 annually, would outperform 80% of actively managed funds over the next 15 years, what would you do with the money you're currently paying in fees and advisor charges? Drop that number in the comments. Whether it's $500 a year or $5,000 a year, I want to see it, because that is real money that belongs in your retirement account, not someone else's. If this video clarified something you've been overthinking, hit the like button and share it with someone in their 50s who's still holding 7 funds they can't explain. And subscribe if you haven't, because next week we're getting into exactly how to set up this 2-fund portfolio and IRA step by step, including what to do if your plan doesn't offer VTI or BND directly. You don't want to miss that one.